a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
We're going to take a look at oil's impact on the junk bond ETF market now with our ETF strategist, Eric Dutram, who has put together a detailed study of the entire situation.
As usual.
That's right. First of all, to say that the oil market's under pressure is kind of an understatement.
That's right. And, we can't really talk about the high yield space without talking about the oil market first. So, we'll just dive into this real quick for oil.
Start diving.
Obviously, the prices for oil have been very weak here over the last, basically, year, and a recovery doesn't really look in sight. And part of that is due to OPEC. There's too many players that need production to stay high, and no one wants to give. And consumption is also part of this equation. China's not really as robust as it used to be. Other emerging markets aren't picking up the slack, so that demand side isn't going to put any pressure on prices either. So, it's a two-way street south for oil right now. And then also prices here, they're below 35 actually just earlier today. And XLE, the big energy ETF, it's down about 21% this year. That leads the spider sectors lower. So energy equities have been hit hard. Oil's been hit hard, and this is starting to translate into some other areas.
And today's December the 16th for those people keeping track on the calendar. So this is all causing investors to rethink their bond holdings?
That's right. You might not think it, but the oil space is really having a big impact on the junk bond market more than anything. This area of the market, a lot of companies in the oil exploration, production space, they issued a lot of bonds. And, hey, when oil was at $75, $100 a barrel, basically a year ago, this seemed like not a bad bet. But prices have languished here, and it looks like they're going to stay low, for reasons that we talked about in the last slide. And a lot of investors are starting to reconsider their bets in this space. And that's really putting a lot of pressure on companies here and their bonds. Default risks have spiked, and this is really creating a broader panic in the junk bond world. It's also hitting companies that aren't in the energy world. So it's just a broader panic that's going across the space.
But you know as well as I that when something is called junk, it's called junk for a reason.
That's right. So these weren't exactly great bets to begin with, but
even worse now.
Right, they're even worse now, and there's actual default concerns out there for a number of these companies, and that's something you really didn't see when oil was $100 a barrel.
All right, let's take a look at a couple of them here. Tickers HYG and JNK. I don't know what HYG stands for.
Yeah.
The others probably stands for junk.
Yeah, the JNK definitely got the better ticker in this case. But HYG is actually the more popular. They're actually both junk bond ETFs, and they hold several hundred securities in this market. So you get a very wide range of exposure. They're, like I said, they're the most popular. They've seen a massive increase in trading activity as investors start to, worry about this space in general. We've seen a lot of outflows, and the prices have really been under pressure for both these securities. And over the past month, they've really been hit hard relative to the other, funds in the bond world out there. And if we look on this next slide here, I've got a chart comparing them. As we see, the two laggards on the chart are the two just described bond funds, HYG and JNK. A little bit of a tongue twister there. And then IEF, that's the Treasury bond fund. It's about 7 to 10 years in duration there. And then LQD, that's investment grade, so non-junk bonds. And as you can see, that's held up pretty well, almost in line with the Treasuries. So this has really been a junk bond specific crisis. We haven't seen it translate into the other corners of the fixed income world.
All right, so if investors want to avoid this whole thing, what do they do?
Well, you get a couple options in this space. High yield municipal bonds. That's one way to go if you still want to stay in the junk space. HYD and HYMB are two choices here. So you're going to invest in higher risk municipalities as opposed to corporations. Okay. So that could be a way to avoid this situation. There's also some more active funds in this space. HYLS and HYLD are two choices here. These are going to be a little more nimble. Granted, they haven't avoided the issues so far, and they've been down almost as much as their peers. But this could be a different way to play the space. They can, they don't have to follow a broad index. They can choose what securities to go into and what to stay out of. So that's definitely an option. And then maybe foregoing the high yield segment altogether. Funds like LQD and other investment grade securities, that might be a better way to play this market right now, at least when these worries are present.
Any other concerns?
Definitely.
I knew that there was something more.
Of course. J&K and HYG, so they only have about 12 to 15% of their holdings in energy. So part of the concern here is it's not just a a energy junk bond crisis, it's more of a broader play against junk bonds in general. And with the Federal Reserve raising rates earlier today, and the possibility of more rates down the future, some investors are worried, hey, this junk bond party might be nearing an end, and might be time to look away from the junk bond space as investors look to higher quality securities in this new tighter credit market. So that might be a way to look, just completely avoid the junk bond space. But granted, some of these yields are pretty juicy in the 7 to 8% range. So it's definitely a battle between yield and credit quality. And it's just going to be a risky market, at least heading into the first quarter of next year.
Okay. Do you own any of those that you talked about?
I do not.
All right. Good move. I guess. If you want any more information on ETFs, commentary, or ETF-specific articles, you can always see them on our website, zacks.com, in the ETF section. And to get there, all you need to do is go to the homepage and navigate using the Funds tab in the top toolbar. With Eric Dutram, I'm Terry Ruffalo.